Here's the right answer to your question, Sarah. For 99% of the people who are watching this broadcast, you should do nothing about it. You should not wake up every morning thinking that you have an answer to whichever direction the line squiggles. You should not think that on a daily basis you have the ability to outsmart the other 100 million people who are trying to buy and sell based on headlines. You do not have that ability. You may be lucky at times. You may catch the right direction in a few stocks. Nothing wrong with that. Have fun, knock yourself out. But if you're out there swinging like a home run hitter at every pitch this market throws at you, you will get more wrong than you get right. The results, net of taxes, net of trading costs, will be absolutely horrendous, and you'll only have yourself to blame. The only advantage you have over the pros as an individual investor is that there are no called strikes, as Buffett would say. You do not have to swing every day. There will be days like this. Work your plan. If you decided you're buying on dips, then do that. It's very simple.
Don't tell that to the day traders. Mike, we've been talking a lot about the rising coronavirus numbers. Sure. And we'll get to that later. But I just want to talk about what's behind the selling today. We've been talking about the numbers. We saw the reaction to some of those Florida and Texas and California numbers. There's also tariffs back in the news, which I think we should mention. And that is that the administration is weighing more tariffs on $3 billion worth of exports from our key allies, Germany, Spain, UK. I mean, this relates to an Airbus ruling. It could involve beer and all sorts of food. Is that playing into today's sort of mood here? I would say, well, I mean, it absolutely doesn't help. I also think that on days like this, you can reach for many plausible excuses for why this is obviously was going to happen. So definitely there's a little bit of a nervousness around policy moves that would not be friendly to an economic recovery happening in the context of an ongoing campaign or whatever the motivations might be. So, yeah, I don't think anyone loved that, but the market was kind of down small this morning until you did get those rising COVID cases. And very crucially, when the huge NASDAQ stocks were not there to take up the slack, because from midday yesterday, they seemed a little bit extended and they were pulling back. And so that's why we're noticing the broad weakness today in a market which even before today, the median stock in the S&P was 20% off its high, and nobody really thought about it because it was obscured by what was happening in the big caps. Right. Taking a step back today, the NASDAQ down 1.8%. Home builder stocks are significantly underperforming the market today. Diana Olick has the details after they had been so strong, Diana.
Yeah, and that's part of it, Sarah. Look, builder stocks are reacting to a couple of things here. First, they were down yesterday, despite a report that new home sales in May really outperformed. But there was a big drop in supply, so builders are going to have trouble meeting the demand going forward. Then we got mortgage applications to purchase a home. And after 5 straight weeks of gains, they fell last week. Still 18% higher than a year ago, but any sign of a turn in demand is going to worry the market. And finally, builder stocks, as you said, have been on a tear since March, and some may consider them a bit overheated. And we're about to get a look at quarterly results from KB Home in the next hour. So we'll see what the comments are from the CEO there. Sarah?
Diana, thank you. Josh, this had been a bright spot in the market and in the economy. Housing demand, mortgage applications. Was that the peak, or is this sell-off an opportunity to keep buying those names?
So I would say it's an opportunity, but I don't know that you'll be rewarded right away. But here's what I want you to think about. We now have a 7-day moving average of 28,000 cases in the United States. That's not good. We're creeping back toward where we were in mid-April, but it's in different places. And the places that it happens to be taking place in are some of the hottest, most robust housing markets in America. It's California, it's Arizona, it's Texas, and Florida. This is where the home markets are the best. So that's going to be a tough situation for these stocks. It might become reflected in things like new home sales. But bigger picture, and when we get through the pandemic, and of course we will, a couple of things in your favor. Number one, the most popular age to be right now in the United States is 29 years old. That is prime household formation age. That is a mega trend. It's secular. It will defy the short-term blip from the pandemic. And then number two, very quickly, interest rates are very low, and we just don't have enough houses. So we cannot build them fast enough for the demand. And actually, the pandemic might be exacerbating that. So if you think about constrained supply, you think about almost unlimited funding for new purchases, and you think about demography, I think you're going to want to be in these stocks, not out of them.